Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about precious metals, banking, economics, and politics. Today is Tuesday, the 1st of January 2019, and we're opening by wishing all of our subscribers a most happy new year and prosperous 2019. Today's video is focusing on a brief roundup of equity markets in 2018 and a general prediction of what we may expect this year. 2018 saw many global stock markets suffer their worst year in a decade. The FTSE 100 ended the year down by 12% at 6,728. The Dow Jones ended the year down 5.6%. The S&P fell 6.2%. The Nasdaq lost 3.9%. Hong Kong's Seng closed almost 14% down on the year. The Nikkei fell almost 15% in 2018, and China's Shanghai Composite SSE declined by a significant 25%. US-China trade wars and slower global growth are among issues blamed for the poor results, plus US political uncertainty and interest rate rises being contributing factors. Europe too has had its difficulties, including Italy's budget row with Brussels, German Chancellor Angela Merkel's waning authority, the gilets jaunes protesters in France, and Brexit. In addition, we have the emerging market currency crisis, and also not forgetting the traditional military conflicts throughout the world. All of these adding to the uncertainty of future growth and prosperity, and thereby the consequent market reactions. From the US perspective, and many may find this surprising, US stock market falls were smaller in scale than those seen elsewhere, arguably in part because of the economic stimulus provided by the Trump administration's $1.5 trillion tax cuts and Jobs Act passed in December 2017. What will 2019 hold for equity investors? Well, without doubt, concerns over world growth will continue, and the US Fed has already claimed that it expects US GDP to decline somewhere around 2.5% growth. Still a positive number, but smaller than what has been experienced in the past 2 years. There was good news announced by President Trump just before the new year, where he tweeted, quote, "Long and very good call with Chinese President Xi Jinping," unquote, and that a possible trade deal was making good progress. China's growth predictions are also down on previous years, and frankly, we will find it difficult to see a scenario where recent economic rises can be sustained, and neither can the markets. Having said that, growth is still growth, and if the world can exceed 2%, while maintaining inflation within that figure and interest rates at an acceptable level, then 2019 may very well see a period of consolidation, or in our view, perhaps further slight declines in equity markets, but not necessarily the bloodbath that many doom-mongers are forecasting. An interesting article appeared in USA Today on the 30th of December by Ken Fisher, where he said, quote, "I was way too optimistic in 2018. That makes me even more optimistic for what's ahead. When most folks expect bad times, stocks usually shine the following year. I see stocks rising 15 to 25% or more in 2019. Whenever you're in a recession, and it's widely recognized, stocks always rise. Sounds weird, but stocks are a leading indicator. They tumble before recessions start, then rebound while the economy keeps sinking," unquote. Goldman Sachs, on the other hand, is not feeling very bullish about stocks in 2019, according to its official outlook report to clients out this week. Here are some of its predictions for this coming year. The S&P 500 will rise just 5% to 3,000 by year end, after closing 2018 at 2,850. Households, mutual funds and pension funds should raise cash. Investors should buy defensive stocks to ride out a tough year where fears of a recession increase. And its base forecast is that stocks will return 7%, Treasury bills return 3%, and Treasuries return 1% in 2019. So again, a cautious approach, but no doomsday scenario, and slightly trending on the bullish side. What certainly spooked markets in December was Jerome Powell's announcement that the Fed would continue to allow securities to roll off its balance sheet as they mature, thereby shrinking that balance sheet. Some market professionals believe the Fed program is removing liquidity from the market, and that could indirectly impact stocks, as the European Central Bank also ends its asset purchases. Of course, none of us have a crystal ball, and events change constantly. In addition, much also depends on how President Trump handles the tariff situation from the US viewpoint, and how Prime Minister May eventually deals with Brexit from a UK standpoint. Either way, whilst we expect some turbulence and spikes and dips, we reiterate, we are cautious equity markets in 2019, but are not expecting the collapse that the doom merchants are predicting. Will we be right? Only time can tell. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.